Harmony portfolios all posted gains in the second quarter of between 0.9% and 4.3% in base currency terms and net of fees for the A share classes. Equity and bond markets mostly performed in line with each other across most countries and regions, delivering low to mid-single digit returns in most cases. So variations in returns across the funds largely came down to the reporting currency and the regional focus of the underlying investments. The Australian equity market was a notable outperformer, while Asian and emerging market equities lagged. One interesting theme evident in the performance of underlying holdings was the continued divergence within equity markets, as higher growth businesses and sectors drove the market gains, while the more cyclical and/or challenged areas were mostly flat or down. Investing in stocks in the latter category, where valuations are usually low and it often turns out that markets have been overly pessimistic, has for many decades been a successful long-term strategy, but has not been working for several years now. We have a balanced exposure across a range of styles in the portfolios, so although our value-orientated managers underperformed, this was compensated for by strong performance from the likes of Granahan in the US funds and Evenlode in the sterling funds, both of which returned 10% over the quarter. We made several changes to the underlying holdings of the portfolios during the quarter. In April, we sold our small positions in the F&C Global Equity Market Neutral Fund, one of 5 funds that we held as part of our liquid alternatives basket. We took the decision immediately after being notified of a significant departure from the investment team managing that fund. All of the portfolios now have lower allocations to liquid alternative strategies across 4 remaining holdings. The proceeds from those sales went towards increasing our exposure to 2 fixed income investment trusts during May and June. The first was the 24 Income Fund, which was already held in the cautious income portfolio but not elsewhere, and which invests in European asset-backed securities, providing exposure to very diverse pools of loans and mortgages. Then in June, we added to our holding in the Sequoia Economic Infrastructure Income Fund, which invests in debt instruments funding global infrastructure projects. The 2 strategies provide different asset class exposures and so have distinct risk and return drivers, and indeed are run by different specialist management teams that are both based in London. But beyond that, they have some attractive characteristics in common. Both provide predominantly floating rate exposure, so are largely immune to the risk of future interest rate rises weighing on returns, and both are invested in more complex niche areas of fixed income markets, where there are higher yields on offer but also greater risks. So selecting the right specialist investment team is critical. Also, the underlying investments are less liquid, but the closed-end investment trust structure mitigates most of that risk and ensures we do not suffer any liquidity mismatch within our portfolios. Both strategies offer distribution yields of 6 to 7% in sterling terms, or higher for dollar-based portfolios where we hedge back to US dollars, which is particularly compelling in the current low-yield environment. As a result, both trusts generally trade at a healthy premium to their underlying asset value, but we were able to invest below prevailing market prices by participating in new issuance windows. Our newly launched Harmony Cautious Income Fund continued to make good progress over the period. The net asset value of the US dollar E accumulating share class increased by 1.7% over the quarter and has now gained 5.8% since its inception 6 months ago. Income share classes paid their first distributions in April and have just paid their second in July, with both equating to an annualized yield of 3.8%. As a reminder, the Cautious Income Fund is the 9th strategy within the Harmony Portfolios range, and like the others, it is a multi-asset, multi-manager UCITS portfolio. The asset allocation is designed specifically to create a lower risk strategy that will provide a stable income over the medium to long term as a core holding for investors. Those capital preservation credentials were evident in May, which was a challenging month in markets with global equities falling 6%, but the Cautious Income Fund held up well with a much smaller decline of only 1.2%. This highlights that the strong growth we've achieved since inception is not simply through taking on undue levels of risk, but rather as the result of careful and effective diversification across various asset classes, styles and strategies. Important qualities which are often not so evident in other income-orientated funds. The fund is available through various currency hedge share classes denominated in dollars, sterling or euros. Distributing share classes will pay quarterly distributions, whilst accumulating share classes will effectively reinvest any income received, resulting in higher NAVs for those classes. The Harmony Cautious Income Portfolio was our first new fund within the Harmony range in nearly a decade, but we're not stopping there for this year. We're currently finalising the launch of a global equity portfolio within the range, which we anticipate will become available later in the third quarter. Although it will be new to the Harmony range, the portfolio has been under management here at Momentum for over 10 years, and indeed is very large with $1.4 billion under management. It is currently in a different fund structure, which is not available to Harmony investors, but will be opened up for wider distribution by re-domiciling it into the same Luxembourg UCITS structure as the other Harmony portfolios. It's run by the same team as the other portfolios and using the same investment approach. It's entirely invested in equities across developed markets globally, therefore the risk profile is higher, but over the long term that should be rewarded with higher returns. The underlying exposures are managed by 9 different specialist investment managers, all world-class in our opinion, and investing with different philosophies, which leads to strong diversification. Given we've run the fund for so long, we're able to speak to a very impressive track record, which is based on real performance and generated by the same team throughout. Over 3, 5 and 10 years, the fund is in the top quartile of its Morningstar peer group and has delivered a return of over 10% per annum over 10 years, in US dollars and net of fees. As well as introducing another leading investment solution for our clients, this new portfolio also broadens out the Harmony range to now span 5 risk profiles, from the lower risk cautious portfolio to the more aggressive global equity portfolio, and everywhere in between, thus ensuring there is an appropriate solution to meet the needs of almost all investment advisors.